Equity in a properly structured life insurance policy is more powerful than equity in your real estate. Hi, I'm Tom Love, and this is another Weekly Wisdom. You cannot get equity out of your home, just like you cannot get equity out of your life insurance policy without selling it. Let me give you an example. Most people do not realize when they take a loan against their life insurance cash values, they're not touching their money. They're actually borrowing from the insurance company. Their money is being held as collateral when using a whole life insurance policy. The only way that you can get money out of your real estate is to sell it. Either that or find another financial intermediary to lend you money backed by the value of your real estate. But you're pledging the value of your real estate as collateral, and you're borrowing money from the banks. This is why they want interest. Have you ever wondered why insurance companies charge you interest on loans that you use from your life insurance? Well, it's really simple. You're not borrowing from your life insurance policy. You simply are borrowing against it. But let's talk about how easy is it to get equity out of my home versus how easy is it to get equity out of my life insurance. Remember, we can't get it out of either example. We're borrowing against it. So let's talk about using our real estate as getting a loan. Let's go over what you need to do. Number one, you need a purchase agreement. You have to identify the piece of property that you're buying, fill out the application, and give an intent to actually buy the property. You need a credit report. You need an appraisal. You need an inspection report. You need 2 years of tax statements, sometimes 3. You need bank statements. You need proof of checks received, proof of checks written over the last 90 days. You need copies of brokerage statements and account balances, underwriting approval. And if approved, 45 days later, you can receive your money. What's interesting is what is not required on this list is your qualified retirement plan, because it is the only asset on the tax code that says you cannot use it as collateral. So all of the things that the lending institution wants as collateral are sources that are mentioned in these statements. Now, let's take a look at borrowing against my life insurance. What does it take to borrow against the cash value that's in my life insurance policy? 2 things. I need to call the company and fill out a form. That's it. No underwriting approval, no waiting 45 days. You could have your money as quickly as 3 to 5 business days. When you need money can be more important than the ability to get it. So if I have to wait 45 days to use my home equity as a source for money, when I could use the same strategy inside a life insurance contract, which way do you think makes more sense?